Good morning, everyone. Welcome to the class, 29th October 2020. Today will be for the continuation of our discussion on adjustments within group accounts. The adjustments you are required to make in the course of preparing group accounts, which arose majorly as a result of intergroup transactions, or what we seem to call intercompany transactions. If you guys can hear me, kindly chat yes or signify by giving the thumb up.
Yeah, we can hear you, sir.
Okay, thank you. Okay, we'll continue. Now we stopped at carrying out various adjustments regarding unrealized profits with respect to intergroup sale of goods. Likewise, we carry out unrealized profit adjustment on intergroup sale of assets such as PPE, intangible assets, investment properties. Likewise, we also consider depreciation adjustment that will arise as a result of this unrealized profit adjustment in the books of the group. We went further to discuss on eliminating intercompany balance that involves payable from one party within the group to another and receivable from one party within the group from another. We also went further to discuss situations where intercompany balance fails to agree. And in that situation, what do we do? Is for us to carry out a reconciliation. And the purpose of reconciliation is to identify where the differences lie. And the differences could span from errors, which you should correct. And in practice, the differences majorly can be attributed to either or combination of cash in transit and goods in transit. And that's where we stop in the last class. Today, we'll be looking further at intercompany adjustments, which involve dividend payable and dividend receivable within the group. What could bring about dividend payable and receivable within the group? First, dividend, it seems to be a return to the shareholder that is paid in form of a cash. Okay, and in that situation, before dividend is paid, the first thing is that liability is recognized. And liability is only recognized for dividend once the right of receiving that dividend has been established by way of declaration and formal authorization of such dividend by the company. In line with IAS 10, event after the reporting date, or what we call the event after the end of the reporting period, dividend is deemed to be appropriately established or approved based on either of these situations and depending on the jurisdiction in which you fall. For example, in Nigeria, for a limited liability company, you understand that it is owner managed, which means the managers are also more or less the owners of the business. Once in that case, the board, which serve as coordinating the activity, equally has approved such a dividend. Such dividend will be considered to have been properly and appropriately declared. And in that position, it is deemed that the right to receiving that dividend has been established to the shareholders. And in that case, the company can go ahead to recognize dividend as a liability as at the reporting date, provided such dividend has been declared prior to the year end. The second scenario, which I also pick in Nigerian context, is for public limited liability company. CAMA rule specifically requires that dividend that is proposed as at the end of the year by a public company have to be subjected to ratification and vote of the shareholders at the annual general meeting. What that simply states is that any dividend declared prior to the year end, which does not constitute an interim dividend, will not be deemed to have been appropriately declared until it has been ratified at the AGM of such a public limited liability company. The reason being that CAMA gives the power to the shareholders to either reduce or nullify such declaration, which means that until that is done, before, for financial reporting purposes, it can be deemed that such dividend has been appropriately declared. And that is the only time we can recognize the right of the shareholders to receiving such a dividend, which means until that point, there's no obligation on the part of the company to pay such a dividend. Okay, that is in Nigerian context. In international context, we have two jurisdictions. Jurisdictions which requires shareholders' approval, and in such a jurisdiction, dividend will only be considered to have been appropriately declared when the shareholders have approved. While in other jurisdictions, the authority to consider such dividend appropriately declared relies on the board of the company, which then signifies that once the board has declared such a dividend, it is deemed to have created an obligation, or because the right to receiving such a dividend has been established to the shareholders. Now, let's put that aside. What concerns us is this: dividend that is considered appropriately declared and has been reported in the books as a liability to the parent and as a receivable to the extent of what is due to the subsidiary in his own book as at the reporting date. And that's what we want to consider. But take note, regardless of the jurisdiction, once dividend is declared after the reporting date, such does not warrant for recognition as at the reporting date. You need to take that into consideration based on our requirement or based on the position of IAS 10, which is the event after the end of the reporting period, and that is it. Somebody said he or she cannot hear me. I think you have to log out and log in. I believe all people can hear me. All other students can hear me. If you can hear me, just on the chat say yes, so that the other candidate can more or less log out and log in order to confirm such. I think a significant number of people has confirmed to me by way of yes, which means must should that Ogunla kindly log in and activate your audio. Thank you very much. Okay, as we move on now, we wanted to look at scenarios where we need to see how dividend is eliminated within the group. Now we'll go back to our material. We'll go back to our material. That is a class exercise notes that we shared at the time. And we'll try to look at one or two examples if practicable. Let me share the slide. Okay, let's look at this illustration 20. Are we there? Can somebody read illustration 20? If you want to read, signify, and let me grant you the access. Signify by raise of hand, and let me grant you the access. O is voluntary. Okay, if not, let me call a name. Who is Olamide Olaide?
I can read, sir.
Okay, who is that?
Owolabi Okoyemi.
Owolabi Okoyemi. Okay.
Yeah.
Can you read?
Yes, sir. Illustration 20.
Yes.
Okay.
It's on the screen. You can also read it from.
Yeah, I can see it. Faramade PLC acquired 80% of the shares of Adebola PLC as at 31st December 2013, when the retained earnings of the latter stood at 40 million naira. The statement of financial position of the dual entities are shown below. Non-current assets, property, plant and equipment, investment in Adebola PLC, current assets, inventories, account receivables, dividend receivables, bank, total assets, equity and liabilities, equity, ordinary shares, retained earnings, current liabilities, account payables, dividend payable, total equity and liability. Prepare the consolidated statement of financial position as at 31st December 2015.
Okay, thank you very much. Thank you for the question. Now, who can tell me what is unique about this question? What is new to us in this question? Which is the principle we want to discuss? What is new?
Dividend payables.
Okay, dividend what?
Payables.
What does that
and
signify?
Dividend receivables.
Okay, if that is the case, let me grant Ekemeze this question. Dividend receivable is showing 8 naira.
Yes.
And dividend payable is showing 10 naira.
10 naira.
Therefore, there is a difference between the two.
Yes.
What account for that difference?
The difference is the share that was given to the NCI holders.
The share of what?
The share of the dividend that was apportioned to the NCI holders.
Yeah, that is correct. Which means you need to have that understanding. You know, what I thought anyone would have thought of is looking at the principle of current account or intercompany balance to say it doesn't agree, therefore probably there's a cash in transit or goods in transit. That does not apply to this. Recall that Adebola declared 10 million naira dividend, and this dividend will be deemed to be due to the shareholders. And if we go back to the question, the shareholders is made up of Faramade that acquired 80% stake, which means NCI acquired what? 20. By the time you look at it, if 10 is declared by a company, the shareholder that has 80% is entitled to 80% of 10. And that gives that 8. While the other 2 will have been accounted for by the NCI in his own books. Okay, and that is that. I'm happy for you to have given me that appropriate answer. Now, what then do we do is to more or less revert to our work notes. And let me share our work notes with us. Illustration, what was the illustration? Illustration 20. What is a group structure?
80% for
Faramade acquired 80% of Adebola. And NCI is what?
20%.
When is our date of acquisition? From the question,
on 31st December.
when? Which year?
2013.
2013. Okay, 31st December 2013. Right, that's 2013. And we are reporting when?
31st December 2015.
December 2015.
Date of consolidation. How many years apart?
2 years.
2 years apart.
Yeah. Now, we need to separate our reserve into pre and post. Adebola's reserve, as at the reporting date, 31st December 2015, stood at how much?
Stood at 40 million.
40 million naira.
Stood at, as at 2016, stood at 60 million. Don't make that mistake.
Okay.
Now we'll now compare that with as at the date of acquisition, which is our pre-acquisition reserve. How much was that?
40 million.
Therefore, what post-acquisition profit has been made?
20 million.
20.
Okay. Because you have grown the reserve by positive 20 million, and which represents a profit. Okay, we'll move further. Now, what bothers me is dividend. Now, I'll carry out dividend analysis. Dividend analysis. What is Adebola's dividend payable?
Adebola's dividend payable.
As at the reporting date was
20 million.
Okay. How much?
10 million.
10 million.
And this 10 million is due to what? The share what?
Shareholders.
And the shareholders can be grouped into two.
Yeah. And NCI.
Which is Faramade and what? NCI.
NCI.
Others. Is that not?
Yeah.
Dividend is paid per share, which means you only take the fractional part of dividend that represents the number of shares you have. And which give us what? 80%.
80% and 20%.
Now, if that is the case, what is this? 80% will give me how much? 8 million.
8 million.
And 20% will give me how much? 2 million.
2 million.
Now, if that is the case, what is intercompany balance? My intercompany balance is the balance between the parent and the subsidiary, which means my intercompany balance is this 8 million. This 8 million is my what?
Intercompany balance,
which have to be eliminated. Therefore, I'll now come here, elimination of intercompany dividend. Now, how do I eliminate? Remember, we said, if you have dividend receivable is an asset, and an asset has a debit balance. To eliminate an asset which has a debit balance, what do? You credit it.
You credit it.
You also have dividend payable to the tune of 10 million, but only 8 million of it is intercompany. And to eliminate intercompany payable that has a credit balance, what do? You debit it. Therefore, I'll come here, I'll say, debit, dividend payable, and credit, dividend receivable. With how much?
8 million.
Which is the intercompany. Any question at this point? Any question at this point?
Okay, so I want to ask if
Yeah.
it's a must that the dividend paid by the subsidiary and not the other way around, like the parent paying dividend to subsidiary or something. Is it a must that it should always be the subsidiary?
Check here. Look at it. Let me go back to the question. If you go back to the question, you see that the parent also declared dividend, 20 million.
Oh, yes.
This is to his own shareholders. Remember, parent cannot declare dividend to the subsidiary because the subsidiary is not a shareholder in the parent. Therefore, that has no effect about elimination. Am I making sense, please?
Yes, sir.
Because the subsidiary is paying dividend, and that dividend is going to its shareholders, and the parent is part of the shareholder. That is why this treatment was given.
Okay.
Is that okay? And take note, this dividend has not been paid. If it has been paid, it will not be in a liability, except if there is an error of not accounting for it. Let us take note of that. Is that okay?
Yes, sir.
Hello, sir.
Yeah.
Please, sir, can you come back with the elimination that you just did now?
Hello?
Yes, sir.
Yeah, you said what?
I said, can you come back with the solution you just did now, the last one, elimination, whatever?
Yeah, I said, if you go by the question,
okay, sir.
The subsidiary has declared 10 million as dividend, which constituted a liability. Okay? And in that case, this 10 million is payable to the shareholders in the ratio they own those shares. Now, in that situation, what then happens is that the parent has recognized his own share, which is 8 million. And we proved it through, let me share my solution. We proved it through the analysis we did here, that 10 million payable by the subsidiary is payable to its shareholders, which is made up of parent and NCI. And if parent is entitled to 80% of 10 million, how much is it? 8 million. NCI is entitled to 20%, how much is it? 2 million. Therefore, we said what is intercompany from our discussion before now is that is any balance that is between the parent and the subsidiary, which makes that what is an intercompany balance is 8 million, because that's where the relationship of parent subsidiary exists. And what happens to intercompany balance upon consolidation? At all points in time, we must eliminate. And that's why I said to eliminate a liability, you have to debit because it has a credit balance. And to eliminate an asset, you have to credit because it has a debit balance. Somebody asked this question. Daniel says, sir, what about in instances where the subsidiary have shares in the parent, or have shares issued to the subsidiary at acquisition? Now, you've mixed it together. Let me start with the last one. If the shares was issued at acquisition, it's not issued to the subsidiary, it's issued to the former shareholders of the subsidiary. They are two separate things, and I think we emphasized that seriously in the last class. Don't make mistake. Upon acquisition, any shares issued by parent in exchange for that acquisition is not to the subsidiary, it's to the former shareholders that surrender their shares. Take note of that. But let me go back to the first expression, which could happen, but they are separate. What if the subsidiary have shares in the parent? It is possible. It is possible. Now, subsidiary can have shares in the parent. You understand? And if subsidiary have shares in the parent, you have to eliminate any dividend payable by the parent ascribed to that subsidiary, the same way we have done in this case. But it's a complex situation for you to find a subsidiary having shares in the parent. And that probably will be discussed at higher level in corporate reporting. Okay? But subsidiary can subsequently in the future buy shares of the parent. You understand? Upon consolidation, that portion will also be eliminated. The share component will be eliminated. The dividend payable element and receivable will also be eliminated. But that is at a complex level, which will be at your higher level. Is that okay? Take note. Daniel, have I answered your question? I want to hear your voice.
Yes, sir, has been answered, sir.
Yeah, but don't ever miss it that the shares owned by the subsidiary is the one issued to the subsidiary by the parent. No. It is the one purchased by the subsidiary on its own, not the one that arose as acquisition, because such exchange is to the former shareholders of the subsidiary. Okay, now let's finalize the question. The main principle is what we have dealt with, which is dividend analysis. Now let's determine our goodwill if it exists. Cost of combination, farmers' investment in Adebola. How much is that? 100. NCI is 20% stake of the net asset, which we don't know yet. We compare to the fair value of the identifiable net assets of the subsidiary as acquired on the date of acquisition. Share capital of the subsidiary was said to be 100. Pre-acquisition reserve was said to be 40. If you remember, this 40. Now that gives me 140. Now 20% of 140 million. That should give me 28.
20.
Is that correct?
Yes, sir.
Okay, that gives me 128. Now it seems we have negative amount of what? 12. Is that not?
Yes, sir.
Therefore, what do you call this? We say is a negative.
Goodwill
Negative goodwill.
or gain on bargain purchase.
If it's a negative goodwill, how do we treat it? We treat it as a gain arising
On bargain purchase.
from a bargain purchase transaction. And how do you recognize gain on bargain purchase in your group account? Who can remind me? How do you recognize it in your group account? Therefore, this will be treated as what? Somebody is opening this book. Will be treated credit to the group what? Profit. Is that not?
Yes, of the parent company.
Attributed to the what? To the
parent alone.
other buttress argument we had on WhatsApp, Abi?
Yes, sir. Yes, sir. I have something.
This is what I continue to tell people, that don't just be somebody that is just looking for answer. And regardless of where you see the answer, you have to be very careful. Your understanding will always give you aid to even query some things, whether rightly or wrongly, but you have intuitive mind of critiquing positively to know the reason why things are done. From there, you can even identify. You know, even some authors, it is people that use their book that also point their attention to certain mistakes. That's why you see sometimes when new edition is done, they make correction of those areas. Likewise, you know, for any student to have identified that mistake in Pathfinder solution, which is a solution on the website of the institute itself. Therefore, that means that student really understand the principle, because otherwise, any student that can just cram that, okay, that's what we do. Next day, they bring that question. The person just do it like that, say, finish it. It came out last day. Do you get what I'm saying now? You need to have that understanding clearly. And I've warned you guys, most of the textbooks outside did not necessarily pass that test of that quality control and some other things. Therefore, you have to be wary of what you use. Okay, And that's why you find out that even the publishers of books will tell you they owe you no responsibility. You understand? You can't sit there and say, it's what I read from your book that I use. And on that basis, you are the one that caused my failure. That does not apply. There's always a caveat in everything. Even in the solution that is provided by ICANN, there's a caveat that they don't take responsibility. It's just a mere guide. Okay, take note of that. Okay, now let's now combine consolidated reserve.
So I have a question, sir.
And what's your question, please?
Why are we going to treat the second leg of this bargain, gain or bargain?
Second leg. Okay.
When we credit the parents for this amount, there's going to be a second leg.
Okay. Let me now start first. Where's the second leg of goodwill? When we got goodwill? Can you answer that question? Sir? I'm waiting for you, sir. Mr. Sadiq.
I guess his network is bad now.
Network must not be bad though. Because it's the one that asks the question and it should be the first beneficiary. Okay. I will explain when it comes back so that it gets it once and for all. Okay. Now, once it comes back, just point my attention to it so that I can ask him. Okay. Now, what is our parent reserve? Faramade's reserve?
140.
140. It has no bearing with NCI.
Yes.
NCI value as at acquisition date. What was it? That was 28, if you could recall. 28. That is 28. Share of post-acquisition profits. Remember, we shared ratio 80 to 20. How much are we sharing? Remember, we are sharing how much? 20 million naira. 80% on 20 is 16, if I'm right, and 20% is 4. Finally, we have gain on bargain what?
Bargain purchase.
Don't be tempted here to share it. I think I've explained this extensively. And if you go back to my book, you can read extensively on it and the reason why. And the whole 12, which is this amount, this whole 12. Now, don't say because we are showing negative here, you go and deduct it. Remember, it's principle you need to understand. You understand? It's a gain. The position of negative 12 here is because we are putting 128 above. If you put 140 before 128, we get positive of 12. What matters is the understanding that you are paying less for more, which means have you lost or you have gained?
Yeah.
Okay. In that case, what do we have? We have 168 and we have 32. Okay. Now let us now show our balance sheet. Faramade PLC, consolidated statement of financial position as at 31st December 2015. All figures in millions. We start with our assets, non-current assets. The first asset I have there is PPE. What is my PPE? I have 130.
130 plus 120.
120. No adjustment. That gives me 250.
250.
Investment was cancelled out, and I didn't even
Yes.
have goodwill. Therefore, that's all. Current assets. I have inventories.
Inventories.
who is always trying to annotate, please don't worry, I'll disable it then. Okay, that is inventory is what, 25 and 45. That give me 60, no adjustments. Receivables, that is how much? 12 and 12, that's 24.
So the inventory is 70, sir.
Okay, 70, thank you. Inventory 70. Dividend receivable, I have 8 and is 0. Somebody will ask me, where is the 0 coming from?
It's
In the
minus
books of the subsidiary, there's nothing like receivable there. I mean, if you have, you add it also to it. Okay, but we said something here that we should eliminate dividend receivable by crediting it by 8. Doing so means I'm subtracting 8. And that gives me what? 0.
0.
I'll still come back to this. Now, the other one is bank. I have
5 plus
5
7.
plus 7. That gives me what? 12. When you add everything together, let me use my calculator.
106.
70 plus 24 plus 12. I have 106. That should give me my total asset. My total asset is 106. That's
356.
Okay. That is financed by
Equity and liabilities.
And what? Liabilities. And that's made up of share capital and reserves. My share capital is Faramade only. That's 80. My consolidated retained earnings, what was it? 168. And that gave me 248. That's equity
Equity.
attributable to Faramade.
Faramade.
Equity attributable to NCI.
NCI.
How much is that?
32.
32. That gives me
280.
80. That's my total equity. My current liabilities, I have account payable. I have 40 and 14.
Plus 14.
54.
4.
I have dividend payable. Now, at this point of dividend payable, I have to separate it. Dividend payable to the shareholders of the parent is how much? 20. Okay? Now, remember there's dividend payable to the shareholders of Adebola. But don't forget,
Yes.
the one for out of payable to the shareholders of Adebola, the one payable to the parent out of it has been cancelled out, leaving out
Yeah.
NCI.
Yes.
Okay,
Yes.
if you remember, what is left is NCI, this 2 million. Are you there?
Yes.
This 2 million is what is left. And that 2 million is what we have here. How do you arrive at that 2 million? Is, remember we have 10 million minus what? 8 million. That intercompany. Let me put it in red. Minus 8. How do you get it? Remember, we minus 8 in the receivable leg. We also minus 8 in the payable leg, which account for this entry we pass. Debit payable by 8. When you debit a liability, you are reducing it, and that's what has happened. Invariably, what do we have? We have 54 plus 20 plus 2. That's 76.
76.
When you add everything together, you have 356, which is my total equity and liabilities. Any question on that? Now, that is how you treat dividend. Any question before I ask my own question? Let me read this so that I can see it at a glance.
Sir, the person that was asking a
Okay,
question is back.
Sir, I have a question.
Okay, what's your question?
Okay, because you said that we have to treat it we have to do it this way if it was a proposed dividend that has not been paid. What
That's
if
liability. That's what I said.
okay, as a liability, we'll see it as a liability. Okay, I wanted to ask
Not
if
all
it was
proposed-
now
Let's listen. The reason why I'm emphasizing is that not all proposed dividend will constitute a liability. That's why I explained the provision of IAS 10 before now. Okay, continue.
okay, if the dividend was paid before the reporting date.
Therefore, it doesn't affect your balance sheet.
Okay, it doesn't affect the balance sheet.
Income statement is separate. When you get income statement, you'll see treatment of income statement. You know,
Okay.
anything that has been paid does not constitute receivable or payable in the balance sheet. Therefore, there's no adjustment.
Okay, sir.
Okay, now, Mr. Danny, are you back? Is it Mr. Daniel or Sadiq?
It's Sadiq.
It's Mr. Sadiq.
Oh yeah, Mr. Sadiq, can you, I think he's not back. I can't see Mr. Sadiq. Sadiq, you are here. Can you unmute yourself, Sadiq Ogumola? Okay, we'll move on. Now, let me put my questions to you. Let's go back to the question. Now, imagine in this place where you have 8, imagine it is not 8. Imagine what is there is 9. Just put 9 there. If 9 is there, do you all accept that we should assume that it is 9 that is here, not 8? What it simply means is that if you go back to our solution, let me share it. If you go back to our solution, it means this will be showing let me enlarge it. This will be showing 9. But we have a problem. The problem is that 9 plus 0 minus 8 is 1. And we expect that we should eliminate it. Who can tell me what has happened and what should be done? If this is what you find yourself, that 9 is what is in the balance sheet, but from our dividend analysis, what we got as intercompany is 8. Who can explain the difference between that 9 and 8 and how should we treat it? Who want to explain that?
I don't get the question. No, you said if it was 9.
Yes, that's the question now. 8 was given to the question, but now I've changed it to 9.
It's 9.
So, sir, where did we get the other 8 that is there? These 8.
Have you forgotten our dividend analysis? That's the first thing we did now. Out of 10 declared,
Okay.
goes to the parent. This is the 8 here now. But the first 8 was given to us in the question. I've now changed that 8 in the question to 9. That's why the 9 is separate from the 8. Therefore, what will have accounted for that?
I'm sorry, sir. Since you changed it to 9, the workings will also show the 9 because since they did.
How much was the dividend declared by the subsidiary? It's showing 10.
10, yes.
And you want to give 9 to somebody that has 80%. How? Why?
Okay. Oh, that means it's.
Who can explain?
Sir, let me say something. I think is it that some of the NCI has a shares in the other company, in the parent company. So I don't know. I'm trying to.
That link. That's not correct.
Okay.
Please, Daniel, please talk. You are chatting. No, let me speak. Daniel, please talk. Adeleke, talk rather than chatting it up.
Okay, this is Adeleke. What I feel is that probably the parent has shares in another organization, maybe an associate. And so that is why the dividend receivable from the parent is 9. And so it has to be accounted for separately.
Yeah, thank you very much. That's the perfect answer. It means it's not only Adebola that Faramade has shares. Probably he has shares in other company that does not qualify as subsidiary. There might be ordinary company which creates ordinary investment in financial asset, or it might be an associate or joint venture. You understand? Which means the only portion you eliminate is a portion that is intercompany, which is this 8, which means invariably nothing stops you in recognizing 1 in your books. Which means anybody that sees 1 as dividend receivable in the group account knows that this is from other investment other than that of the subsidiary. And that is it.
Yes.
That's it. Please let us take note of it. That is it. Okay. Who answered that question?
Adeleke, sir.
Adeleke. Okay. You two, you have won yourself a book. Eh?
Thank you very much.
Yeah, thank you. Okay, let's go back to the question. Any other question before we go? And I'm going to answer, what's it called? Sadiq question. I think Sadiq is having challenges with the network. Therefore, any attempt by him to answer to ask question, his network always malfunction. Okay. Now Sadiq is asking question, where is the corresponding entry? Don't forget, the corresponding entry is already embedded in it. Let me show you. Let me go back to the question. If you come to the investment, you see that it's 100, have you? What it simply means is that instead of you recognizing 100, you are now showing entry of 112 as your investment, which means for you to recognize that gain of 12, you have debited investment account with 12 and you are crediting your gain with 12. That is why at the end of the day, it totally cancels out that you are not showing any amount of goodwill in your books. Are you getting it now? And that is just it. Otherwise, there will be minus 12 hanging somewhere. But because you have more or less recognized that as additional value to yourself, as a way of investment, that's nil it off. That's why the corresponding entry is that you debit investment with 12 and you credit group profit with 12. And eventually, the investment you have credited with 12 is now 112. By the time you now come back to your account here to say if investment is 12, if investment is now 12, what you simply have is 112 plus 28, which gives you 140, and 140 will cancel what? 140, and that's what has happened. Okay, we can read that more. By the time you get my text, you can check it more there for more scenarios and explanation. Any other question? Okay, in the absence of that, Adeleke is still raising up hand.
Hello, sir.
Yeah, what's your question?
Yes, sir. Sir, according to this illustration, it means that whenever we see a question, we should work. Hello, sir.
Yes, I can hear you. I can hear you.
Hello, sir. Can you hear me, sir?
I can hear you.
Wow.
Okay, I think I
wanted to ask that means whenever we see, okay, sir. Whenever we see a question.
Okay, you know what you can do?
Whenever we see a question, we should always work on the dividend from the NCI.
Okay, yes. Let me put it out.
From the subsidiary, the dividend payable from the subsidiary.
Yeah.
So that you know what to eliminate.
See, that is very perfect. That's why I carry a dividend analysis. Don't ever. What is asking is that at every point in the question when you have dividend, you must independently compute to determine what portion goes to NCI and parent. Yes. That is why I emphasize that dividend analysis have to be carried out to know what is the actual amount of dividend payable to subsidiary, payable by subsidiary to the parent and to the NCI, regardless of what the parent is carrying in his book. Because parent might also carry other dividend receivable from other investment outside the group. Take note of that. And that is what this has tried to portray. Thank you very much. Okay, let's move on. The next one we're going to look at is loan. Loan. When you have intercompany loan, what happens? Now let's look at this illustration. Illustration 19, page 37. Let me share the screen so that you can read it. Okay, can somebody read for us? Illustration 19.
Arsenal acquired 70% of the ordinary shares of Manchester United on 31st December 2013, when the balance in the latter retained earnings stood at 40 million naira at a consideration of 220 million, and also invested the sum of 60 million naira and 100 million naira in the 8% preference stock and loan notes, respectively, in the subsidiary. Required, prepare the consolidated statement of financial position as at 31st December 2015.
Thank you very much. Who can tell me what is unique in this question? What is unique in the question?
Our current liability as a debenture.
Current
And
liability.
there's a deferred consideration too.
Liability. You said current liability has a debenture. Is that correct? Is it correct? Is it current liability or non-current liability?
Non-current, rather, non-current liabilities.
Please let us be careful. Okay, continue.
That's to
There's
the
also a
subsidiary of
deferred
120.
consideration.
There's also a deferred consideration. Where do you see that? Do we have deferred consideration?
I don't think so.
We don't have a deferred consideration. Check your question well.
I don't think so. It's not there.
Who else want to explain?
I thought there's someone.
Who else want to explain? What is unique about this question? If not, let us continue. Okay. Now we are told Asda's investment is made up of following. They are told Arsenal invested by acquiring 70% shares in Manchester United on 31st of December when the reserve stood at 40 million for a consideration of 220, which means equity investment in Manchester United was 220. But if you go to your balance sheet, the total investment in Manchester United is 380. But we are told that it's 220 invested in equity. What account for the other investment? Let's go back to the first paragraph. It says, and also invested the sum of 60 million
and 100 million, 8%.
And no, which means he also invested in another equity. This first equity is ordinary shares. Abi? The second equity is preference what? Shares. Investment in money, and that is 60. And the third one is debt investment, which means he bought part of the debenture note for 100 million. This is what makes up that 380, which means you need to be very careful so that you don't jump to carry cost of investment 380 and canceling to determine your goodwill. No, you must break it down. The only portion that relates to goodwill, which affects goodwill invariably, is the equity position. And the equity position that is much more influential is that of ordinary shares. And we're going to see that. Now, let us draw the group structure. %. What is our NCI? What's our NCI?
30%.
30%.
What's our date of acquisition? Our date of acquisition is 31st December 2013. And I'm reporting 31st December 2015. Which is 2 years apart. Okay. What is Manu's retained earnings? as at today. How much is it in our balance sheet? We are told it is 50.
50.
Which we can divide into two. The one as at date of acquisition, 2013, which is pre-acquisition, and the one that is what? Post-acquisition profits. As at acquisition date, how much was it? We are told it was 40. Have you?
Yes.
Which means post-acquisition is how much?
10.
Okay. Thank you very much. Now, what then do? We determine our goodwill. What is my goodwill? Cost of business combination. ASNA. ASNA Investments in Manchester United. Remember, ASNA has 3 investments in Manchester. Let us go back. 3 investments, but only 2 of them relate to equity. Therefore, it's those 2 we are going to consider because goodwill deals with equity. Now, the first one is ordinary shares investments. That is 220. The second one is preference shares investments. That is what? 60, which means the whole of equity investment is 280. Now, we'll also now consider NCI. Okay, NCI's investments in Man U. Now, NCI also have 2 levels of investments. Ordinary shares, which we are going to find 30% of the net assets, excluding preferential capital. Remember, we all mentioned 30% here, have you? Now, it also has preference shares. Now, if you go back to the question, the preference shares capital of the subsidiary, look at it here. Let me highlight it. It's 100. The preference share of the subsidiary is 100, but of which only 60, see the 60 here, based on the information we have here, was invested in it by the parent, which means other shareholders outside the group invested in the balance to make it 100. Which means if subsidiary issue 100 million preference share capital and the parent only bought 60 million of it, others belongs to other shareholders outside the group. Which then means that those other shareholders, remember, we have collectively grouped them as what? NCI. And that means I'm going to say this is 100 million minus what? 60 million. which means like 40% of the preference share is owned by outsiders. Remember, outsiders are considered to controlling. Okay, sorry, I've not shared it. Thank you. Thank you. Therefore, 100 million minus 60 means that the balance of 40 belongs to NCI, others. Okay? Now take note. NCI or preference shareholders never participate in retained earnings. If you understand the principle of ordinary shares, preference share, and etc. Preference share, even though may be equity, but rank ahead of ordinary shareholder, and they are not usually a risk bearer because they still have claim over the asset ahead of ordinary shareholders, which means the residual interest holder is only the ordinary shareholders. And that's why they are the one that bear the risk of a business. And therefore, they are the one that participate in the residual earnings, which you call the retained earnings. Take note of that. Now, we don't know what our net asset is. We'll now go down to say, let us determine the fair value of Manchester United net assets as at date of acquisition. And that is made up of the following: ordinary share capital, ordinary share capital is 600. Remember, retained earnings belongs to ordinary shareholders only, not to any other shareholder or any other debt holder. Therefore, remember, we are looking at pre-what? Acquisition. And from the question, we've analyzed that our pre-acquisition.
Excuse me, sir.
Yeah.
Said fair value of the fair value of Man United is not 600, sir.
First, our pre-acquisition is 40. Now your question says the fair value is not 600. Nobody said it's 600. We are breaking it down. Fair value of net assets broken down into ordinary share capital, which is 601. Retained earnings, pre-acquisition, that's the one I showed you earlier. Sorry, okay, I was speaking 600, 250.
Yes,
okay,
that's what I'm saying.
I said share capital of Man U, not fair
that's
value.
What I said. I said share capital. Okay, yeah, sorry.
Okay, that's 250, not 600. $250. Thank you. Now our pre-acquisition reserve is 40. Therefore, we'll come here, we'll say 40. What that simply tells us is that 290 is the net assets attributable to ordinary what? Share what? Holders. Let me clean it and write it clearly. I'll say 290 is the net assets for ordinary what? Share what? Holders. But that is not the total net asset. To obtain the total net asset, I have to bring in the preference share capital of how much? 100, which means the total net asset is 390. Okay? But 390 is for both preference shareholder and ordinary shareholder. But I need to distinguish separately from both with that of ordinary shareholder, because that of ordinary shareholder, which is 290, is what is relevant for ordinary shares here, which is 290. Otherwise, if you have picked this 390, you'll be double counting, because in this 390, there's this 100, which 40 has been taken care of for NCI. Therefore, you must take note of that, which means 30% of 290 is 87. Now look up, this 100 portion has been recognized as 40 for NCI and 60 for what? For the parent. This 60-40 is what this 100 is standing for. This 100 is standing for. Why 87 and 220 is standing for this 290, and that's what we are trying to achieve. Take note of it. When you have preferential capital, that is the way you treat it. Therefore, this will be 127 127 plus 280. Who can add it together? What do we have?
407.
407. Yeah. We can now compare 407 with 390. What is our goodwill?
17.
17. Thank you. What is unique here is that when you have preference share capital within your equity, and which is not a liability, what you need to note is that this portion of share capital will be shown separately from the net asset from ordinary share capital, or because you will have shared that 100 between parent and what? NCI, based on the information made available. Any attempt to lump it together at 390 and share it here, you have double counted for NCI. Okay, now let's go back. What is our consolidated reserve? All figures in millions. What is the reserve of the parent? What's the reserve of parent? Arsenal. Arsenal's reserve is 290.
290.
NCI asset acquisition. From the information we had there, NCI asset acquisition is 127. Is that not? Yeah.
Yes, sir.
Next is share of profits. Take note, I told you that profits retained is only due to the ordinary shareholders, which means the ratio you are going to use is the ratio of investment in ordinary shares, which is 70-30. 70-30 of what? What is our post-acquisition? Our post-acquisition is 10 million. I'll come here, 70% of 10 million is 7, and 30% is 3. No other adjustments. I'll have 297 and 130. Therefore, I can drop my balance sheet. Arsenal Group, consolidated statement of financial position as at 31st December 2015. Assets. Non-current assets. PPE. We have 500 and 360, no adjustments. That gives me 860. Investments in Manchester United. Now remember, before I leave, what have we cancelled out eventually? Out of 380, we have cancelled out We have cancelled out 220. We have cancelled out 220, and we have cancelled out what? 60. What is left is 100. And unfortunately, this 100 is still an investment in Man U, but the only difference is that it's a debt investment. If this investment has been in any other entity other than Man U, what we'll have done is that we will have come down here. We will have come down here to say investments in other entities. We'll have said 380 minus, remember we cancel out 220 and we cancel out what? 60. Which means what we cancel out is 280. That 280 you have here. Remember this 280 here. That's what we cancel out. At the end of the day, what do we have? We'll have had what? 100 here, which represent other investments. But unfortunately for us, this 100 is still in Man U, only that is a debt instrument. And what it simply means that that 100 is inside the non-current liability of Man U, because remember Man U issued the debenture of 120. Let me share this slide again. Man U issued investment of 120. If you go back here, this non-current liability Man U issued this debenture which is 120. Out of the 120, the 100 we are talking about, this 100 now, which relates to loan notes. Is part of this 120, which means there's an intercompany balance of the common factor, which is what? 100. Therefore, what do we do in this case is to go and eliminate intercompany balance with respect to loan. Now, what we do to eliminate intercompany balance? In the books of the parent, it is investment, which is an asset. In the books of the subsidiary, it is debenture, which is a liability. Therefore, what do? I'll say elimination
Sir, please share your whiteboard.
Okay. Thank you. Now, what I said earlier was what I showed there. This 100 million, I said eliminate intercompany balance with respect to the loan. And to do that, I come down here to say eliminate elimination of intercompany loan balance of how much? 100 million. In the books of the parent is an asset. Therefore, you credit it in the books of the parent, which means debt investment of Arsenal in Man U. And in the books of Man U, it is a liability. You now debit liability account, which means you are reducing it. Debenture loan notes in Man U. Therefore, how much is common factor? 100 million. This 100 million simply means that when we come here, you find out that the 380 has cancelled 280 before, remaining 100. That 100 will also cancel 100, it has gone. We'll now come to 120. 120 will cancel 100, what will be left is what? 20, and that is what we'll consolidate. And that's what we are trying to achieve. Remember the principle of elimination of intercompany balance. And we're going to see that. Okay, which means in this case, what I'm to do now is that this 100 will no longer surface because I've eliminated it. Therefore, what should I do to show that? Is that I will show that 260 and 100 has gone. Therefore, this is what is 0. Since I know that, I need not show this in my balance sheet. I can just rule it for you because I've fully eliminated. Therefore, it's supposed not to show in my balance sheet. Let me try and do a straight line. Okay, therefore I can continue. What is left is my current, okay, I think we have goodwill. Goodwill of what? 17. If you can check, 17. Now that should give me 877. What is my current asset? Okay, my current asset is lumped together. My current asset.
Sir, please, I can't see your screen.
My screen is finished. Check your system. Check your system. Is there any other person that cannot see the screen? Can you see it now? Can you see my screen now?
Your screen is visible.
Yeah, please check your network, okay? 260, 280 should give me 540, if I'm not mistaken. Therefore, when you add it together, you have 1,417. That's my total assets. Financed by what? Equity and liabilities. Share capital and reserves. Share capital will only be for Arsenal. And there are two groups of share capital. We have ordinary share capital, and we have what? Preference what? Shares. We only pick for the parent. How much? 600, and preferred shares 100. That's for the parent. Our retained earnings as consolidated. How much is it? 297. 297. When we add it together, that is 997. Equity attributable to Arsenal. Non-controlling interest. How much is it? 130. 130. That is 7211. If I'm not mistaken, that's our total equity. Non-current liabilities. We have debenture. I think it's not clear enough. non-current liabilities. We have debenture. Remember, the parent did not issue debenture, it is 0. The subsidiary issued debenture 120. But remember, we have eliminated 100. This 100 is the same thing as this 100 here, if you remember, this 100 here. Okay? And that gives us 20. And let me put it there. Next is current liabilities. My current liabilities are 150 and 120. That gives me what? 270. All things being equal, what is my total equity and liabilities? $1,127 plus 20 plus 270. That gives me 1,417. That is that. Let me show you the solution at a glance. Any question?
Sir, I have a question, sir.
Yeah, what's the question?
I just want to confirm that when we are solving in exam, the investment that you cancelled out, do we have to show it and cancel out, or we just leave it out complete?
That's what I explained. If you follow me well, I explained that I'm just showing you so that you see how it disappears. But you are not demonstrating that to examiner because you are not teaching the examiner. You understand? You are solving questions for the examiner to demonstrate that I know what I'm doing. Do you get what I'm saying now? You need not show it. You understand what I'm saying now? Rather, you might show it as part of your work to know what balance you have to carry there. But probably if it's going to have a balance, you might likely show it to show how you arrive at it. But it's neither here nor there. Is that okay, sir?
Yes, sir.
Any other question? Any other one? Any question? Yes.
I have a question.
What's your question?
I didn't really get the stuff though, but I was thinking the loan stuff, the loan intercompany loan or something.
Yes.
Is it should does it always come to the debentures, or there's a way they can still?
Does it always come to what?
Through the debentures, or there's a way they can say they transfer the loan from this person.
Oh, now you know what loan means now. Loans is
Yes,
borrowing.
I know, but
just
I
wait, madam. Wait. Loans are borrowings, Abi, and there are major different ways of obtaining loan. You can obtain loan by way of bank loan, which means you go to bank. You can obtain loan by going to capital market to issue bonds. You can obtain loan by going to OTC market. OTC market is over the counter market to issue debenture or to issue commercial paper. Are you getting what I'm saying? Now, these are instrumentalities of borrowing. Therefore, any of them is what they can describe for you. Does that make sense?
Yes, sir.
Therefore, if somebody borrows, regardless of the way they say it, you know that this is borrowing. Very simple. Tomorrow they can use the word loan stock. Tomorrow they can use the word bank loan. Tomorrow they can use the word commercial paper. Tomorrow they can use the word bond. all of these things are instruments of raising funds by way of borrowing. One party is lending, who is the investor. The other party is borrowing, which is the borrower. Very simple. Any other question? Any other question? Which means the same way we eliminated payable and receivable is the same way you eliminate loans payable and loans receivable. Any other question? Okay, in the absence of no question, I'll take us to something. Even though at your level it's just descriptive, but at higher level, you are still going to do all of what you have done now in corporate reporting. Only that we upscale it by a little to more or less advance it for certain transactions that are not common or certain transactions that can make it complex. Like one of the questions asked by Daniel with respect to subsidiary investing in the parent. Okay. Now, but let's look at this. Let me share my screen. You can read it up in my text. Okay. The one I'm showing you is the Amazon version. That's the Kindle version. Let me take chapter 9. Okay, let me take chapter 8 first. Other principles in business combination. Now, you know, we've discussed the issue of uniform accounting policy. Now, I demonstrated that understanding here based on our explanation, where I put up a question to demonstrate that, and can read it further. But again, it might not necessarily be applicable to you, but to higher level, which is at corporate reporting. Okay. I think another one I introduced here is contingent liability, because remember we discussed that the exception to the rule of IAS 37 is the requirement of IFRS 3, which requires upon acquisition that where a subsidiary has a contingent liability, which would not have been recognized because of the provision of IAS 37, such will have to be recognized at the acquisition date fair value in the books of the parent in the process of consolidation. That process of recognition and subsequent measurement is what I discussed here. But again, this is at corporate reporting level, which you can see illustration to demystify that understanding. Okay, let me move to chapter 9. Other adjustments you can see, which is not at this level, are those ones I'm going to show you. We've dealt with all of these ones, but the only difference is that I have up to about 8 examples here coming from different perspectives. What matters to me now is to show you other adjustments that is not at this level. Okay. Other adjustments are like where you have accrued intercompany or intragroup service charges and income. This is one of them. Or where you have bill of exchange. One has bills receivable, the other has bills payable, which is similar to trade payable and receivable. But one thing that is unique in addition to bills of exchange is that bills of exchange are tradable instruments. which you can sell before maturity, and you sell it at a discount. The question also is, what if you sell it at a discount? What is the effect on group account? That's another one we discussed. Bill of exchange discounted. Okay, that's another adjustment at higher level. We have treated the one of intragroup loans. Okay, and we have also partially discussed the preference shares. But there's a chapter on preference shares separately, which I'm going to show you. Now, another adjustment is bonus issue, which is also at higher level. If bonus is issued by the subsidiary after acquisition, in which the share capital has increased and also the investment amount remain the same, how do we adjust for that? And that is that. And also on the basis of, is the bonus issue from pre-acquisition reserve or the bonus issue from post-acquisition reserve? All of that effect is what we also discussed here. For your future readings, which is for corporate reporting, you can also check that. Okay, dividend analysis is the one we just discussed. Okay, and the beauty of it is that the position we adopt today is the position as revised in 2011. But there was a position different from what we are doing today prior to 2011. From the book, I was able to show today's position and compare it with positions of previous years, so that those people that understand what was it before, during the period of IAS 27, which no longer exists today because it has been replaced by IFRS 10, we have a better understanding of this position. Okay, which means for those people that have done it long time ago, they can easily, more or less, convert their understanding of old standard to new standard. And that's the beauty of what it is here, so that you can see how different the solution will have been, isn't that? And I think that is that. Let me go back to, okay, before I go back to chapter 7. Now, these are summaries you can read up in the book. Each of the chapters has a summary and also have a question. Summary is to demonstrate all of the salient principles, and it's been summarized for your understanding, so that if you know that you have not grabbed any of the summary, it means that you have to go back to the body of the material to read further on the areas that you were unable to summarize but were contained in the summary. And these are some of the questions. Let me put some questions to you here. Let me see who can answer this question. Now, on what basis is an adjustment for unrealized profit on inventory required? Who can answer that question? Let me see how professionally you are in answering this question. On what basis is an adjustment for unrealized profit on inventory required? Imagine they give you this question for 5 months, bonus. What do you do? Who will answer that?
One is sir.
Yeah,
Can I try, sir?
Yes.
Okay, if unrealized profit can arrive in a situation whereby either parent or subsidiary sell a goods to each other, and at the end of at the time of reporting period, there is some leftover of that inventory that yet to be sold by any of these parties.
What you have answered is the reason for that is the reason for unrealized profit. Okay. Now I'm not saying that on what basis is an adjustment carried out. Now you have justified the reason why we need to carry out adjustment, but what basis are we going to adopt in carrying out that adjustment? What methodology are we going to adopt?
Hello, sir.
Okay, in a situation whereby,
continue.
In a situation whereby it is the parent that sold to the subsidiary, we have to calculate the portion of the remaining inventory. By calculating it and know the amount of the profit they put on it, either given in the question, either cost, either margin or markup. After getting the amount they're putting on it, you have to go back to the parent consolidated reserve to remove it from the reserve.
Okay, who else have idea? Who else have idea?
Good morning, sir.
Good morning.
Yes, sir. The basis is simply that the parents and the subsidiary are one. And any transaction that is happening between them is treated as intergroup transaction. And so they cannot make profit from one another. So that adjustment is required in order to cancel the effect of intergroup transaction, just to show that they cannot make profit from one another because they are one.
Okay, we'll check whether we're right. Now, the second question is, how should an unrealized profit arising from intercompany sale of goods by a subsidiary to the parent be treated in group accounts? You can answer that.
We debit the retained earnings account by the amount of the with the amount of the unrealized profit and credit from the inventory account.
Okay. How does that affect parent and NCI then? Who else?
If it is subsidiary that sold to the parent.
Don't say if again now. They've told you who sold.
Now,
like if.
Okay, that means the unrealized profit have to be shared between the parent and the NCI.
That means the implication of the unrealized profit loss will affect the parent and NCI in what proportion, sir?
In the proportion of their percentage of their shareholder could share.
Yes. Like that. The proportion they share profit or loss. You know, the way you have to present your stuff should demonstrate professionalism.
Okay, sir.
That's why you see that when doctor, pharmacists are writing to themselves, they write in technical. If they say they should give you Panadol, they won't write Panadol there. They will write something that you cannot see. Therefore, because they are trying to more or less show that they are professionals in that field. You understand? You must present your answer in a manner that demonstrates that you are a professional in that field. Is that okay, sir?
Thank you, sir.
Okay. Now, the third question. I don't know whether you guys are right or wrong. I'm just asking this question. How should an unrealized profit arising from intercompany sale of motor vehicle by the parent to the subsidiary be treated in group accounts? Who can answer that? Who can answer that?
Sir.
Yes, sir.
For the treatment of unrealized profits from the sale of motor vehicle from parent to the subsidiary, we have to try and understand how it moved, in the sense that how much was it sold to the subsidiary and the difference in them. So it's the difference that we would charge and remove from the profits, the retained profits of the.
How does that affect the parent and NCI?
How does it affect the
parent and NCI?
It doesn't affect the NCI.
It doesn't affect them. It does affect only the parent company.
Is that correct? You use the word it doesn't affect them. Is that correct?
It doesn't affect the NCI.
Exactly. You have to be specific. It doesn't affect what? NCI. Why? Who can explain why?
It's basically because the parent is the one that made the profit in quotes from the subsidiary.
Yes, and therefore, he has over-recognized profit that was not appropriately realized. Therefore,
Exactly.
he should return part of the profit, and that is it. Which means, why I'm doing this is for you to have understanding of why you are doing things. It's not that, that's what they told us, that's what the standard says. Why is it done? I've more or less uploaded the solution to this class we just did. You can download it. It's already on the chat. Please kindly download. Okay, now let me share the answers with us, and let me see that the answers to all of the end of chapter questions on chapter 15. Okay, no, chapter 14, sorry. Okay, guidance on end of chapter exercises. I think the one we did is chapter 9. Okay, chapter 9. Now, the first question answer is adjustment for unrealized profit on inventory is required only when there is an intercompany sales in which the price include an element of profit loading and of which part or all of the goods remain unsold in the hands of the other entity within the group as at the reporting date. Now, the person that answered the first question, grade yourself now based on this answer. What will you have gotten over 5 based on your answer? Be honest.
2.5.
2.5. That means you're a generous examiner. Probably I'll give you 2. Okay, now let's look at the second one. An unrealized profit on inventory within the group should be eliminated against the profit of the selling party. Now, this is telling you of the selling party. Now, who is the selling party in this case? Subsidiary. And adjust also the inventory value of the buying party. Who is the buying party in this case? Parent. This is required in order to allow the group to present inventory value at cost in line with the requirement of IAS 2 or net realizable value as the case may be if it is lower. Both the parent and NCI bear the effect of the adjustment where the sales were initiated by the subsidiary because it's the subsidiary that has recognized the profit that is deemed not to be realized. Okay. Now, the third one is an unrealized profit on the sale of motor vehicle within the group should be eliminated against the profit of the selling party. Who is the selling party in that case? The parent, and adjusted against the current amount of the motor vehicle of the buying party. Who is the buying party? Subsidiary. This is required in order to allow the group present the asset value at its original kind amount, as if the sales was not initiated. Given that the sales was initiated by the parent, the entire unrealized profit is adjusted against the parent's profit or loss. Can you score yourself? The person that answered second question and third question, score yourself honestly. Okay, now let me go to chapter 8. No, chapter 7. 7. Okay, yeah. Chapter 6, the preference share capital. What we discussed today, you can read it up further in chapter 6, where you treat preference share capital in a group. Remember, under IAS 1, I think Bash will have also explained to you that it's possible for you to have preference share capital as equity, and you also have it as liability. And to know that, please go and watch the video on financial instruments. Part 1 to 3 I've sent to you guys. Okay, because remember that this diet is very short. That's why I've done those videos. It's from chapter 1, which is IAS 32, that you have an understanding of when can preference share capital be considered to be equity and when it can be considered to be debt. Okay, but what we are discussing here is that if it is equity, the treatment I gave to it in the question we solve is the treatment you have it to be. But if it is liability, the treatment I gave to the loan by eliminating intercompany balance is the same treatment you give to it. Or because preference share capital can either be equity or a liability. And the treatment goes in line with, if it is equity, you treat it the way we just solved this Arsenal group question. And if it's liability, you solve it the way we treated the loan in this same question by elimination. Okay, and I think on that basis, that brings us to the end of today's, of this morning session. Okay, we'll come back in the evening to solve questions. The last question, past question for September examination, which was for July 2020 diet, question 3, and we also solved the November 2019 diet, question 3. Okay, I've given you those questions as assignment before now. Please attempt it before we come back 5 o'clock so that you can have a better appreciation of the solution that we are giving. Okay? Any other question before we call it a day? Okay, if that is the end of the class, we call it a day. Please kindly download it before we shut the platform. Thank you very much, and God bless you guys.
Thank you. God bless you, sir.
Thank you. God bless you, sir. I'm coming back here. No. I didn't sleep.